Your gold position is bleeding red. The world is on fire. Yet, here we are. I need to ask you something directly. Do you actually understand the mechanism behind what you're watching? Because if you don't, the decision you make in the next 30 days will determine whether you capture the trade of this decade or miss it entirely. I've spent 40 years studying precious metals through every geopolitical crisis the modern era has produced. What I'm about to show you isn't theory. It's a mechanical pattern that is repeated without exception after every major energy shock since 1973. Once you see it, you can't unsee it. Let me start with the question financial media won't answer clearly. Why does gold fall during a war? It defies logic. Gold is the safe haven, the asset you're supposed to own when bombs are falling. So when Iran shut down the Strait of Hormuz, why did gold drop from 5,099 to 4,612? The answer is a six-step mechanical sequence. Write this down because once you internalize it, you'll recognize it every time. Step 1. Geopolitical event triggers an oil shock. The Iran conflict drove Brent crude from $75 to above $112 per barrel in 3 weeks. Step 2. Oil spike elevates inflation expectations, and in financial markets, expectations matter as much as reality. Step 3. Inflation expectations locked the Federal Reserve out of rate cuts. The oil shock killed that conversation. Step 4. If the Fed can't cut, bond yields stay elevated. The 10-year Treasury yield currently sits at 4.39%. Step 5. When bond yields hit 4.39%, the opportunity cost of holding gold, which generates zero income, rises dramatically. Institutional capital rotates from gold into Treasury bonds. Step 6. Simultaneously, global investors seeking safety buy U.S. Treasuries, strengthening the dollar. The dollar index climbed above 100. A stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars. 3 headwinds hitting at once, all 3 caused by the same oil shock that conventional wisdom says should be massively bullish for gold. This is why your gold is red while the world burns. But here's where the story shifts completely. This mechanical suppression doesn't last. I've watched it resolve the same way every single time. 1973. OPEC embargoes the United States. Oil quadruples. Gold initially drops, then rises 150% over 2 years. Zoom out to 1971-1980, and gold climbed 12,300%. 1979, Iranian Revolution. Gold surges 89% over 12 months. 1991, Gulf War. Gold jumps 10% in weeks. Post-2001, gold begins a decade-long bull run from $250 to $1,900. That's 660% over 10 years. 2022, Russia invades Ukraine. Gold breaks through $2,000, printing new all-time highs. Every major oil shock in 50 years, followed by significant gold outperformance. The mechanism that temporarily suppresses gold. Higher yields, stronger dollar, forced selling eventually reverses. And when it reverses, the structural case for gold reasserts itself with full force. What makes this cycle different isn't the war itself, it's the structural conditions underneath it. In 1973, U.S. national debt was $500 billion. Today, it's $39 trillion. That's a fundamentally different fiscal reality. In 1973, central banks were selling gold. Today, they're projected to purchase roughly 755 tons this year, still elevated versus pre-2022 averages of 400-500 tons annually. That's strategic repositioning at a scale never witnessed before. In 1973, there was no silver supply deficit. Today marks the 5th consecutive year where industrial consumption outpaces mine supply. 5 years of structural imbalance that doesn't resolve because silver mine supply is largely a byproduct of other metals. In 1973, industrial demand for silver was a fraction of today's levels. Now silver goes into every solar panel, electric vehicle, AI data center, defense system, semiconductor. The industrial demand base is structurally larger and less replaceable than any previous cycle. And in 1973, the Fed had room to raise rates to 20% under Volcker to crush inflation. Today, the Fed is paying $1.03 trillion annually in interest on $39 trillion in debt. It cannot raise rates to 20%. The arithmetic doesn't permit it. Every structural condition is more extreme. And the mechanical suppression holding gold at $4,612, when JP Morgan's year-end target stands at $6,300, Wells Fargo's at $6,100, $6,300, UBS's at $6,200, is temporary. That gap is the unthinkable I'm talking about. Let me walk you through the four-phase recovery pattern. Phase 1, the panic phase. First 1 to 4 weeks. Oil spikes, gold spikes, then drops hard. Financial media runs 24-hour coverage designed to maximize anxiety. Retail investors panic sell at the bottom or panic buy at the top. Both wrong. Institutions watch patiently, positioning carefully. Phase 2, the absorption phase, months 2 to 3. Initial panic subsides. Gold pulls back from its spike, sometimes significantly. Silver falls harder, 15–20% or more. This is where individual investors make their most expensive decision. They see red headlines about gold being broken, and sell. In 40 years, I've seen this after every major crisis, and it's always the worst time to sell. Phase 2 is almost always the bottom. Phase 3, the structural bid phase. Months 4 through 18. The market stabilizes. Panic-driven selling exhausts itself. Structural buyers, central banks, institutional investors, retail re-entering, begin accumulating. Gold finds a bid backed by central bank buying, supply deficits, debt dynamics that make monetary debasement inevitable. Most retail investors sit on the sidelines, having sold in Phase 2, watching gold make new highs. Phase 4, new all-time highs. Month 12 onwards, sometimes extending 2 to 3 years. The oil shock embeds inflation. Inflation forces the Fed to keep rates elevated longer than the economy can sustain. Eventually, the debt arithmetic overwhelms the inflation-fighting mandate. Rates come down, the dollar weakens. The three headwinds reverse simultaneously. Gold responds to all three tailwinds at once. Based on timeline and price action, I believe we're in the transition between Phase 2 and Phase 3. Panic selling has occurred. Forced liquidation has largely exhausted itself. Structural buyers are beginning to accumulate at current levels. Now let me address silver specifically. In the 1979 cycle, silver outperformed gold by a factor of 3. Gold rose 276% from the Iranian Revolution to its 1980 peak. Silver rose from roughly $5 to $50, a tenfold increase. Silver is both monetary and industrial metal. In crisis, monetary properties drive the initial move. But as crisis embeds into the system, industrial properties add a second engine gold doesn't have. That second engine is more powerful now than any previous cycle. Solar installations require silver as conductor. Demand not price sensitive because silver cost is a fraction of total system cost. EV production requires 60–80 grams per vehicle versus 15 to 20 grams in conventional cars. AI data centers, defense electronics, satellites all require silver with no viable substitutes. 5 consecutive years of deficit. No supply response coming. Industrial demand growing in applications where silver is irreplaceable. China, controlling 60% of global silver refining capacity, has restricted exports as strategic material. When monetary bid returns to silver in Phase 3, industrial demand adds to it rather than subtracts. That combination produces silver's pattern of lagging gold, then overtaking dramatically. I'm watching 2 indicators to identify when the reversal from Phase 2 to Phase 3 has fully arrived. First, the US dollar index, currently elevated above 99 due to petrodollar demand surge from the oil shock. When DXY falls back below approximately 97, the primary mechanical headwind on gold diminishes. This happens when oil stabilizes, when alternative supply routes absorb enough Hormuz disruption to reduce emergency dollar demand. Second, the 10-year Treasury yield, currently at 4.39%. When this falls below 3.5%, the opportunity cost argument against holding gold weakens to where institutional rotation back into gold becomes mechanically favorable. This happens when the Fed begins cutting rates, which happens when the debt arithmetic of $39 trillion at 4 to 5% makes continuation impossible without causing fiscal crisis worse than the inflation risk. These two indicators tell you when mechanical suppression is exhausting itself. The war news won't, daily oil headlines won't, financial media's 24-hour cycle won't. Watch the dollar, watch the yield. Everything else is noise. Wells Fargo has lifted its year-end target to $6,100, $6,300 per ounce. JP Morgan forecasts $6,300. UBS projects $6,200. These aren't retail wishes. These are research departments of institutions managing more capital than any other entities on Earth. They're issuing these targets because they believe the suppression is temporary. There are two types of investors watching this unfold. The first type sees gold at 4,612, down from 5,195, and concludes the trade is over. They sold at the bottom of Phase 2. 6 months from now, when gold is making new all-time highs, they'll say they knew they should have held. The second type sees the same price and thinks, Phase 2, absorption, mechanical suppression, structural setup more bullish than at the top. They accumulate quietly while the noise is loudest. I've watched both types across every major crisis of 40 years. I know which type builds wealth, and I know which type watches from the sidelines. The unthinkable is the move coming when Phase 3 begins in full. Not unthinkable because it's never happened. It's happened after every major oil shock in 50 years. Unthinkable because the structural conditions are more extreme than anything I've seen in 4 decades. More debt, more central bank buying, more silver deficit, more industrial demand, more fiscal constraint on the Fed. Watch the dollar, watch the yield, be patient, and don't let a Phase 2 sell-off make you miss the move. Every major institution has already calculated is coming.